Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Okay, happy Tuesday everybody. Today's video will be very heavily focused on the ongoing housing crisis, which has now seen 11 consecutive months of sales and bond price collapse. There have been several major recent developments which we need to cover today. Hong Kong-based South China Morning Post reports yesterday that Beijing has dispatched high-ranking officials, including cabinet ministers, across the country to demand local governments do more to stabilize growth. Quote, a rare move that may indicate the economy is in worse shape than official figures suggest. End quote. We remember last week the State Council, China's cabinet, ordered teams to carry out inspections in 19 provinces, including economic powerhouses like Guangdong and Zhejiang, just before the latest announcement of more stimulus, another 1 trillion yuan, mostly for infrastructure. All signs that Beijing remains alarmed by economic slowdown. Quote, the large-scale inspection is necessary because July economic figures are not optimistic and the main issue is believed to be local implementation. If August figures show no obvious improvement, the central government may have to double down on policy support. End quote. Analysts say that the two biggest areas of concern for the central government officials travelling to these localities are the banking system and the property market, especially unfinished apartments and the mortgage boycott movement. Indeed, the team led by China's housing minister, Ni Hong, visited unfinished property projects, with the minister expressing at one inspection, quote, local governments should guarantee the delivery of pre-sold homes, earnestly protect the legitimate rights and interests of home buyers, and maintain social stability. End quote. The mortgage boycott movement has especially spooked regulators who recognize the potential for financial crisis and social instability if mismanaged. We remember back in late July, China's Supreme Politburo called for action to, quote, stabilize the real estate market, end quote, and the use of, quote, city-specific policies, end quote. Today, Tuesday, Chinese financial outlet Caixin reports that, according to several of its sources, China will soon issue 200 billion yuan, approximately $28 billion, in special loans to help developers finish stalled housing projects. The central government will provide interest subsidies of 1% on loans to policy banks for no longer than 2 years, and the borrowers will be local governments, who will then socialize the completion of apartments. The special loans will be recorded as local government debt. Quote, a liquidity crisis among China's property developers has led to a plunge in new projects and put about 5% of existing apartment construction on hold, sparking mortgage payment boycotts by angry homebuyers. The spreading mortgage strike has sparked fears that the crisis will further squeeze Chinese banks, which are already grappling liquidity stress among developers. The strike also poses a risk to the broader housing market by keeping homebuyers on the sidelines. End quote. The analysts write that regulators have made it clear that this 200 billion RMB National Rescue Fund, quote, doesn't aim to stimulate the real estate market or rescue developers, end quote, and that the funds, quote, will be strictly limited to the construction and delivery of residential properties that have been sold or suspended due to developers' liquidity difficulties, end quote. But even with this limited scope, some commentators wonder whether $28 billion will be enough to complete so many unfinished apartments. Others wonder, rhetorically we assume, if these projects were prepaid in full, where are these funds now? Of course, we know that mismanagement, misallocation, and misappropriation are the answers to this question. The cruel irony is, of course, some of these funds likely did find their way into finished properties. However, these properties are in Sydney, London, and Vancouver. At any rate, Caixin writes that local governments will, quote, comb through local housing projects and review developers' assets and liabilities before lending the funds, end quote. Banks have also been told to expand credit to embattled developers, as well as smaller businesses, even as lending margins shrink and bad loans pile up. And we remember from last week that some banks, even state-owned ones, have admitted that they do not want to touch the toxic industry out of fear of being dragged down too. Policymakers will work hard to stop the mortgage boycott from spreading, and some of the damage to the financial system is already becoming quite apparent. For example, we learned yesterday, Monday, that the Agricultural Bank of China, China's third largest bank by assets, estimates that its overdue loans have already doubled to $178 million due to the boycotts. Quote, the Beijing-based lender said that the overdue loans are linked to 1,112 projects as the protest by purchasers of unfinished projects sweeps the country. The bank previously estimated $95 million of loans were affected by the unprecedented protests. Chinese banks' exposure to the property sector tops that of any other industry, making them vulnerable to the woes that have already roiled capital markets and burned the nation's middle class. End quote. We remember earlier this month, S&P Global Ratings estimated, as a worst-case scenario, that 2.4 trillion RMB, or 6.4% of mortgages, are at risk. Hello everybody, if you're enjoying today's episode of China Update, don't forget to hit the like button, and as always, anyone who wants to go the extra mile and help me keep China Update sustainable and primarily subscriber supported, Patreon and Buy Me a Coffee links are in the description below. This is a tremendous help to keep the channel going. Thank you so much everybody for the ongoing support. The docking of a Chinese research ship in Sri Lanka has caused a minor diplomatic incident between the world's two most populous Asian giants over the weekend, highlighting yet again the intensifying geopolitical rivalry between China and India in South Asia. After initially declining the request, Sri Lanka cleared China's Yuanwang 5 vessel to dock at the Hambantota port from August 16th through 22nd. The Indian side accused Beijing of applying pressure on Colombo to host the vessel, which New Delhi also suspects is being used to spy on its trials of several new domestically developed missiles. Quote, the Yuanwang 5 is primarily a satellite monitoring vessel, but it is also likely able to gather telemetry data from missile launches. India could be worried that the Chinese ship would be able to gather data from such tests. On Friday, the Chinese embassy in Sri Lanka tweeted that Sri Lanka had every right to okay the ship, and that, quote, external obstruction based on so-called security concerns, end quote, is nothing but, quote, interference with Sri Lanka's sovereignty and independence, end quote. The following day, India's embassy then tweeted, Sri Lanka, quote, needs support, not unwanted pressure or unnecessary controversies to serve another country's agenda, end quote. The Hambantota port itself is not without controversy. The port was constructed with borrowed money, and when Colombo had difficulty servicing the debt, it granted China a 99-year lease on the facility. Sri Lanka is currently grappling with its worst ever economic and political crisis. Okay, that is today's episode of China Update. Thank you so much everybody for watching. I'll see you tomorrow.